Hey traders, this is Blake Morrow with Trader Summit, and I'm really excited that I get to bring in Marc Chandler from Bannockburn Forex. He's one of my favorite people to talk to. Matter of fact, he's such one of my favorites that you'll notice right on the back here. Marc, you sent me that book maybe about 15 years ago, maybe 12 years ago, and I have all of your books sitting over there on one of those bookshelves, and it's so nice to see you.
It's always good to see you.
So before we even get started, tell us a little bit what provoked you to write, making sense of the dollar.
Yeah, I think that that book actually grew out of spending almost 20 years and some capacity in the currencies or the global capital markets, writing about it, speaking about it. And so I thought that, and I think that, I think as traders, you can appreciate that if the dollar is, say the dollar has been rising and you say it's gone far enough, I'm going to sell it. You're willing to take a view contrary to the market, contrary to everybody else. And it takes a certain sense, I think a certain ego, a certain sense that you have something to say or that you see something that others don't. And that, I don't know where that comes from, but I think that in that book, Making Sense of the Dollar, I take 10 things that people were telling me about the foreign exchange market and why, through my experience, they didn't seem to be true. Like the U.S. trade deficit means a weaker U.S. dollar. We've had a U.S. trade deficit since I got involved in the markets, which was shortly after the Plaza Agreement in 1985. And the U.S. never has had a trade surplus, but yet we've got huge rallies in the dollar over those years. And so I take a look at those kind of what I think are myths, sort of rules of thumb that don't really hold up under scrutiny.
So I'm glad you brought up trade deficits. So I mean, how much is okay? Let me rephrase this question. I was having a discussion with a few other people, and I know just before we hit record, you had been traveling, meeting clients, talking macro. Talk to us a little bit about the macro environment, because from my point of view, at least in currencies, maybe it matters a little bit more, but for the rest of the market, people could care less about what the overall view is. They're just buying anything and everything that's not bolted down to the floor right now. So when does macro really matter to you in the markets?
Yeah, sure. I think just the idea of like let's buy everything kind of mode, to me, that's part of the macro story. And so for me, when I first began, there was a real division in the markets and practitioners between technicians, people who study the price action, assuming that the markets are efficient, and the prices contain all known information. And there were the macroeconomist types who tried to forecast a GDP or current account or inflation and try to forecast currencies based on those economic variables. And they were like I don't know, Protestants and Catholics, or Sunni and Shiites. They in offices, there was always a tension between the two camps. And I had decided at an early age that even like my approach at the university was very much interdisciplinary. Like someone had like political science, economics, sociology, anthropology. Aren't they really the same subject? Instead, they're studying the same subject, people. And so I kind of thought that what we really want to do is take money out of the market. We want to trade profitably or help others trade profitably. And for me, the way to do that is a combination of technical analysis. It's got a certain role to play, and macroeconomic analysis. And so to me, I couldn't separate the two. Say like, well, what should we focus on today, macros or technicals? And to me, and I try to use that in the commentary that I provide, is really bringing the two worlds together. For me, knowing that where support and resistance are, or where trend lines are, or knowing that that in the IMM futures market, going into the EU parliamentary elections, the market was long euros. To know market positioning, to have an idea about where my trade idea, where can I be wrong? And I think that's really important. I think everybody has their own way of handling successes and winners. But it's really what we do with losers that I think separates the trading. And it's really in my experience, what I found is that what separates the people who make money from those who don't is not that the people who make money are right more often. And I think, I used to talk to Dennis Gartman from the Gartman Letter about that a lot too. And his experience was the same thing, that being right more often is not the way to make money. It might help on the margins, but the real way to make money is disciplined risk management. Know when you're wrong, admit you're wrong, and don't have these type of stops. We used to joke they'd be good until close. And when they're close, you move the stop. As opposed to GTC, good till canceled, good till close. And I think that the markets, I think, at their best, they really make us humble. I think about, I came into the last couple of weeks thinking that the dollar was going to strengthen. And then yesterday, we had that soft CPI number, and the dollar got hit pretty hard. Now, it's come back quite a bit since then. We're not back quite there yet where we were before the CPI, but we've come back a long way. And where do we put our stops? Where do we admit we're wrong? I kind of thought I'd be wrong at about 108.75, 108.85. We stopped at about 108.55 or so. We're back down towards the lows. I'm kind of thinking support now in the euro, 107, 107.20. And I think we go through there. It could be worth another cent. And what strikes me about it today, and this is where I try to combine that macro and the technical, the U.S. rates are lower today. In fact, the U.S. rates took out the CPI low after the PPI data, and yet the dollar has strengthened. And this tells me that up till now, I've been arguing that what's underpinning the dollar, interest rate differentials, like other people, the Federal Reserve being higher for longer, ECB cut rates. We've got 5 of the G10 central banks have cut rates. And so I thought that when the Fed begins cutting interest rates, the dollar will fall, and that'll turn the cycle. But here we have a day where interest rates are sharply lower and the dollar's firmer. And to me, this tells me that maybe there's something else driving the markets right now. What could that other thing be? Well, I sort of think it's politics. And the politics, you think about what the weakest currency so far this month, Mexican peso, right? And the thing there is nothing real on the economy side. It's really about the politics. Same thing in the euro. The euro did sell off after the U.S. jobs data on June 7th. But what's really clocked it, I think, and what spooked the market now is what's the politics in Europe. French calling an election, and this is it's kind of a scary proposition. We haven't talked about someone leaving the Eurozone in a while, and I'm afraid that people will think that if Le Pen wins, that this could begin a process of weakening or at least confronting France and the EU, leading the tensions. And it's not just France. There's other countries in Europe that are vulnerable, say like Italy, with high debt levels. Italy, what I'm reading suggests that Italy could be cited for not being in compliance with the EU budget rules. And the EU budget rules they're sort of I want to say they're silly in a way that I'll give you an example. In France, the central bank just cut their growth forecast. And the reason they said they cut their growth forecast for France was because they've got fiscal consolidation. So because they cut the growth forecast, that means the budget deficit will be larger than it previously was as a percentage of GDP. So now the government's got to cut more spending. And so it leads to this vicious cycle and a pro-cyclical fiscal policy. So this is a long-about way to say to you that right now I think that it's not interest rates that are helping the dollar today or maybe in the last couple of days, but it's really more about politics. And the French seem to have put, not only did the ECB cut interest rates before the Fed for the first time, but their politics look a bit worse than ours, a little bit earlier than ours. I mean, we'll have our own circus later this year. But right now, I'd say politics is really a driver, the euro underperforming. And then Mexico, I mean, you've got the first woman president who's not even in office yet. And the trick here, and this is sort of a little bit of a nuance, but the new Congress in Mexico sits in September. She does not get inaugurated till early October. And so in this month's time, I had talked to portfolio managers ahead of the election, and they were worried about what AMLO could do in that month that he's got with the new Congress, supermajority in the lower chamber, before the new president sits. And what they're talking about is constitutional reform. And, in the U.S., we elect some local judges. We don't elect the Supreme Court judges. And what they're talking about in Mexico is electing Supreme Court judges. And
Oh,
I think this scares investors because many people don't like AMLO's policies, but they recognize that the central bank and the Supreme Court were these institutional like guardrails that really protected the long-term interests of capital investors and sort of the rule of law and that could come under jeopardy. And, the peso through May, the 24 months through May, the peso was up about 15%. I want to say it was the strongest currency in the world. Since the election on June 2nd, the peso is off, I don't know, 9%, 9.5%. It's given a lot of it back. And the challenge there, this is again why like market positioning and technicals, these things matter too. A lot of people, this is asset managers, the people who are managing maybe your 401k global bond fund, or speculators, non-commercials, that's the CFTC name for us, non-commercials in the futures market were longer the Mexican peso than they were any of the other currencies going into the election. So you have all these longs who have to get out. And so there's not natural buyers of the peso. I mean, we at Bannockburn, we have some clients who have to fund their Mexican operations and send pesos back into Mexico, say running a call center or something like that. But for the most part, the real money is there's not people who really want to buy pesos right now. Most people want to sell pesos because they already have them. And so this leads to this huge market imbalance. And so what you sort of see happening is someone dumps some of the pesos, it pushes the market, the peso down. They wait a little bit, and the market just naturally, as they distribute these pesos they sold, the market stabilizes, then come back in and sell more. And that's sort of what has been happening. And I think it's really politically driven, but understanding the market positioning becomes key, and then knowing these key levels, stopping at 19 the other day, for example.
yeah. Yeah, well, so Mark, you make a great point, especially regarding the peso. I've been trading it quite a bit. I happen to be long a lot of it before its big run about a week and a half ago. But so I've been trading in and out of it quite actively. And from what I'm reading, some of the banks that have reported back on carry trade exposure, they assume only about 20% has been covered up. Maybe now, talking several days later, you're talking maybe 20-25% of a lot of those carry positions have already been covered up. But what happens if we actually see a little bit of risk aversion, and that might actually speed up that process a little bit, wouldn't you think?
Yeah, well, I thought we were headed that way earlier this week. Before the CPI and the FOMC meeting, bank shares in the U.S. were under pressure. I think we were near the lows for the year, and this reminded me a little bit about last March when we had a little flare up, and the Mexican peso gets hit in that risk-off environment. And so to me, it's a bit pushing on an open door here. The Federal Reserve and the low CPI and PPI has really pulled back. We've seen some of the bank stocks beginning to rally again. And so I think that right now it's more of an idiosyncratic thing, but not just to Mexico, really. But if you look at the weakest currencies, I want to say this month in emerging markets, they're all in Latin America, peso, but Brazil's also been hard hit. Not as bad as Mexico, of course. Mexico is really by far the leader. But so I think that we might be seeing some kind of rotation. My guess is to what's happening is that as production moves out of China, and I do think production is moving out of China, even if it's slowly, and even if it's hard to see in all the data, the anecdotal stories seem to be too great. And so as it moves out of China, where's it going to go? Maybe some goes to South America, but I think that a lot of it stays in East Asia. And so countries, so I'm looking for those countries in East Asia, actually, and those stock markets to do a little bit better. While in Mexico, for example, a lot of people talk about the nearshoring and onshoring and being close to the U.S. and all that great story, but most of the foreign direct investment going into Mexico this year was not new, what we call greenfield investment. It was really retained earnings. And why would some companies, primarily U.S. companies, retain earnings in Mexico? Two ideas. One, some people say, well, they're building up their war chest to make some real investment in Mexico. That's a possibility. But I'd suggest to you maybe something else is going on. Mexico has 11% overnight interest rates. You're a corporate. You've got some extra cash balance. What do you do with it? I said, keep it in Mexico. When the peso is strong and interest rates are high, you get a better return on the money. And so some ways, even though it looks like direct investment, it might really be portfolio investment. Sort of the same way, right? We're told that light is both a particle and a wave. Here, we've got these four direct investment category, but it might be really portfolio flows.
No, that makes a lot of sense. I've actually talked to a few people that that move money back and forth from Mexico, being where I'm currently located, and I see a lot of that, and could shake the trees a little bit. Hey, Mark, I want to talk to you about another subject matter before that I think is near and dear to both of us. You know, we've been grinding higher. U.S. equities, European equities. NASDAQ just hit an all-time high. You have just massive moves in some of these leadership stocks, whether it's Nvidia or AVGO, which is Broadcom, and Apple that blew up this week higher. We've just been seeing this insatiable bid in global equities. It's hard if you're trading currencies, it's hard to know what currency is going to do better in a risk-off type of environment. So, you know, if stocks actually found some sort of high and they started to move down, what do you think is what currency is going to show up as more of you know, is it going to be the yen that takes the mantle again as the chief risk off currency, or is it going to be the dollar or the Swiss franc? Do you have any feelings on that, and which currency is going to do better in an environment where stocks actually come down?
Well, interesting how when stocks fall. I mean, of course, many of us keep waiting for this pullback, and many of us, we get the pullback and we don't really recognize it's a pullback because it's too shallow. It doesn't last long enough. To me, I think, and this is again why the broader context is important. A couple of things I'd say. One is that the U.S. stock market typically does not fall in the fourth year of a presidential presidential year. This year, so there are a couple of occasions where it happens, but then you've got like a much bigger problem, like in 2000 with the tech bubble and in 2008 great financial crisis. But for the most part, the two sort of regularities, if you will, the U.S. doesn't have a recession in the fourth year of a presidential term. Stock market doesn't go down in the fourth year of a presidential term. So why would the stock market go down? Well, I think that becomes the key. Really, is why. I could see a scenario in which the Federal Reserve cuts interest rates later this year, and rather than rally like perhaps a lot of people in the retail community might think, oh, Fed's lowering interest rates, let's buy stock. That tends not to be one of the regularities. Typically, the stock market falls in the 12 months after the Fed cuts, because the Fed's cutting rates, not because the economy is booming. They're cutting rates because the balance of concerns is more about an economic slowdown than inflation.
Yeah.
And so if you were to tell me that we don't get a recession this year, maybe things slow down, the uncertainty over the presidential election, and maybe some of the policies of the new president, or who, you know, whatever term that is, and the Federal Reserve cuts interest rates, weaker economy, maybe then we get the recession, stock market sells off. In that environment in which the stock market sell-off is led by the Fed cutting interest rates, of course, I think that this would be the kind of scenario that I'm looking for the dollar to put in a major top. And it's the top. I mean, of course, people are like me. We've been thinking that's coming and coming, but it's sort of like tomorrow, always coming, but never quite arrives. And I think that the turn. I mean that. It's weird to talk about some of these things that are only valuable in the extreme. And that's why I just bring this up for you. I know I can imagine some people's eyes are going to roll, but the dollar on a purchasing power parity basis is as stretched as it's ever been. It's more stretched now than it was when my career began. Like I say, right after the Plaza Agreement. And that Plaza Agreement, for people who are too young to remember it, the central banks met at the Plaza Hotel in New York, the G5, Canada and India and Italy weren't invited, and they agreed the dollar had gone up too far. They began driving it down, coordinated intervention. The dollar was overvalued then. We were having big trade deficits. On a valuation basis, the dollar is more overexposed, overextended than it was then. In yen, it's about 65% undervalued, and the euro is about 55% undervalued. which helps explain, I think, why some smart people like, I don't know, maybe Warren Buffett buying Japanese equities, Japanese brokerage, Japanese trading houses. That is to say that for me, my money is here in the U.S. I work for a U.S. company. I have U.S. stock in my 401k, maybe a little bit of international stock, but I'm trying to get advantage of this kind of time with the dollar as being so rich to begin diversifying my own savings a little bit away from U.S. equities, which I'm so terribly exposed to, and buying Japanese and European stocks. Now, you're right that European stocks have also rallied. We're near record highs there as well. Uh, I think that what's going to happen, though, is that it's going to take several years, but the dollar will adjust. And exactly what the trigger is, like I say, I think it's going to be Fed cutting rates, U.S. economy going into recession, slowing down, serious slowdown gets the Fed to cut rates more, bring us back down, say to even, I don't know, 3% Fed funds rate or something like that. And so I'm taking advantage of this to diversify, but knowing that the currency is going to be a nice tailwind for me by having euros at these kind of valuation levels, or yen at these valuation levels. Takes years for these things to turn around, but I still have enough of a runway to think about that.
So, Mark, you bring up a great point about maybe the dollar marking up a very important high, and how on a PPP valuation, it's way overvalued. What is the debt to GDP ratio, U.S. debt to GDP ratio? Does it factor into any of your decision making about the dollar?
Yeah. So think about the debt. I think I agree with most people who think that the debt is on unsustainable trajectory. But if this was an imminent problem, I would imagine that U.S. interest rates would be a lot higher. And so to me, I'd say it's sort of like what Ronald Reagan said. They asked him once, you're cutting taxes, you're increasing spending. What about the deficit? And Ronald Reagan, who might be too liberal to run for president in the United States these days, he said that the deficit was big enough to take care of itself. And I sort of think along those ways that politicians are not going to do anything until they're forced to. And the market is not forcing them to. I mean, we just had, like I say, we're at the US 2-year and 10-year yields are basically at 2 to 3 month lows, even though the deficit is getting bigger. And so I think about the deficit, but it's not so much of a crisis, but the kind of one of these regularities that I look for is a country that has tight monetary policy, loose fiscal policy. That's what Reagan and Volcker had. That's what Germany had when the Berlin Wall fell. That's what the US has now. Tight monetary policy, loose fiscal policy, and the currency, it's sort of like the federal government's got their foot on the accelerator, the central bank has a foot on the brake, and the currency gets squeezed higher. That's the kind of policy mix we have right now in the US. That policy mix changes, then I think that's the signal to become to rethink about the dollar. But right now, I think, yeah, the fiscal deficit is large, and that's part of the reason why the U.S. is growing so much better than most of our allies, our friends, as well as our competitors. So yes, I'm aware that the U.S. has a huge deficit. I don't like it. My answer would not be, I mean, I think that we sort of know the direction we have to move into. We just don't want to do that. Two things occur to me. One is a national sales tax. We have state sales tax now. I think that a federal sales tax, like most other industrialized countries have, would probably be a step in the right direction. And the other thing is that people who make more than whatever it is, $160,000 a year or so, sort of a cap on Social Security. Social Security needs more funding. And I can imagine them lifting that cap and making people who earn more than $160,000 a year still pay for Social Security, just like we do for Medicare. And so I think that we're in a situation where the U.S., we like the basket of goods we get from the government. We just don't want to pay for them.
Yeah, well, Mark, you're saying all the right things, but saying all the things that no politician is gonna wants to do or face, right? So,
Which is why I'm a currency analyst and not a politician.
well, I'm sure we could all appreciate that. Well, Marc Chandler for president. I think I'm sure I could come up with a great slogan for you. Mark, I always appreciate having these conversations with you, and you're so knowledgeable, so insightful. And if you guys and gals appreciate what you hear from Mark, make sure you give him a thumbs up, and click the subscribe icon so you can get all these interviews that we have. But Mark, I love your blog. I read your blog every day. We post it on Traders Summit. We try to post it every day as well. tell us why you express yourself in blog format. Because I've been reading it for literally like 20 years now. So tell traders why you do that.
Yeah, so it's kind of a strange kind of thing because you know, I began doing it because I could, in a sense that I was writing commentary for a bank. And when I began my career, I'd be writing commentary. I'd write a special weekly note, and I would roll over the fax machine and by my desk, and I would just be programming numbers all day, all afternoon on a Friday. And along comes the internet. I just realized other people had websites and blogs, and it didn't really appeal to me because I thought, like, how does anybody find you? How, like, I kind of thought it was sort of like peeing in your pants, might give you a warm feeling, but like, who notices? And so I had a young woman work for me who told me that I was thinking about the wrong way. She said to me that the social media was, whether it's the web or Twitter or LinkedIn, that these were the main avenues of communication going forward. And I began experimenting, and I was fortunate.
And you said, what do you mean? I'm in your fax machine. What are you talking about?
Yeah, and yeah, you know, it seemed to work, and so I was persuaded. And what happened is I spent most of so the last 20 years, actually a little bit more than that, at different banks. And as I launched the blog, the banks didn't have standard operating procedures or rules for it. So I sort of got grandfathered in. So if I began doing it before they had rules about it. And so I find that for myself, a couple of things. One is I find that by writing things down with my hand, I can remember a lot more than I do by just reading. And at the end of the day, I think that what I'm doing is really sharing publicly what I'm giving to clients privately. And that is to say, my employers recognize the importance of branding, and they recognize that, you know, we have this old model of value, scarcity. Now, I remember, I think it was Medley Advisors. They used to only sell their commentary. They didn't want to sell their commentary to salespeople who only could give it to their customers. They wanted to give it to decision makers only. And so they came out with some large prices. You know, other newsletters like to do that, charge a large price and have this like sense of scarcity. You're reading a scarce thing, even though some of the same people who write this go on TV and tell everybody their views. I was able to convince my bosses at the different places I've worked that that's a old-fashioned idea of value. What makes commentary valuable and ideas valuable is that they're widely shared. That is, people are talking about them. And that's what I always wanted. I mean, I know some people have this idea of like becoming very wealthy or very powerful. And I grew up a very like lower middle class, single mother, 4 kids. My brother and I had to share a pair of gym shoes and dress shoes one winter. We're taking turns who had PE classes that week or that day. And so I had very low kind of ambitions. And I just wanted to participate in the dialogue of the day. And it turns out that my contributions tend to be on economics and finance, while my real love is much more, and that's why I put myself on LinkedIn as a political economist. If I had a choice between like the State Department and Treasury, I like the State Department, but it doesn't pay. And so I find that my career, I've really been doing Treasury-like things, thinking about the foreign exchange market. And the blog was just really a way to share those views and to help whoever I was working for build a brand.
Well, Mark, I tell you, I for one have appreciated you over the years, and I know for people that don't know how to find Mark, make sure you find him on Twitter or on X, Mark at Mark Making Sense. Is that correct, Mark, with a C?
Yep, Mark
Yep.
and C, make my mom happy.
Yeah. Well, I tell you, Mark, it's always a pleasure catching up with you, and appreciate your views. And I want to wish you the best of luck. If you're trading through the Bank of Japan tonight, I'm not gonna hold your feet to the fire with what the BOJ may or may not do, because unfortunately this will come out after the fact. So good luck with that.
Yeah, BOJ it's going to be interesting. You know, everybody else is cutting rates, and the BOJ most likely not going to raise interest rates until maybe next month, and maybe another hike before the end of the year. But the BOJ is in a different world. And that's one of the things about the, we're talking about the technicals and fundamentals. I find that, I run these correlations. I'm always looking for like what's moving with what. And to me, one of the best guides for dollar yen is U.S. interest rates, 10-year yields. And I often find a correlation higher with U.S. rates than Japanese rates, and higher with U.S. rates than the differential even. And so, I think that yeah, I mean, every currency has its own personality and everything, but I tend to think that U.S. 10-year yield and the Japanese yen are like Aunt Jemima pancakes and Aunt Jemima syrup.
I love it, Mark. Marc Chandler, everyone, make sure you give him big thumbs up. Mark, thank you so much for spending your most valuable time with us. I'll catch you, hopefully catch up with you right at the end of summer, and we'll do this again.
Great. Thanks a lot. Good luck to everybody.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.